talk about Regulation A plus, or Reg A plus, as we sometimes call it, which is a large-scale crowdfunding thing that you know everything about pretty much. I'm more of a novice. We do have an expert. So let me give you a little bit of Rod's background. This is Rod Turner. He's the founder of Manhattan Street Capital, the #1 growth capital marketplace for the best mid-sized U.S. and Canadian companies. He has been a senior executive of 2 IPOs to NASDAQ, Ashton Tate and Symantec. Ashton Tate back in the early days provided the database software for the original PCs back in the DB2, DB3 days. I remember that when I used to use Lotus 123 and used WordPerfect. So
WordPerfect, right.
Those were the early applications on the personal computer. He also worked for Symantec in the early days, even before they bought Norton Antivirus. So very experienced guy. He's also been an angel investor in many companies, including Ask Jeeves, INFM, AMRS, eASIC, and Bloom Energy. He's a high-energy strategic thinker with an engineering background and skills in the areas of business. He's also an experienced M&A expert, and Rob is a contributing writer to Forbes, and you can find him on @IamRodTurner on Twitter. So welcome, Rod.
Thank you. Thank you very much. That was very nice to hear.
So how big is the Reg A plus market likely to become over time?
So I've done a lot of work on this, starting from different points and different assumption sets to build scenarios. And when I do that, I look to see that the results are similar, and then I'm okay. If they're very, very different, then I know I've got a problem. So essentially, $50 to $60 billion of growth capital will be raised using Reg A plus based on my assumptions.
Over what period of time?
Per annum once it's fully established.
Wow, that's huge.
Yes, it is. I mean, it makes sense if you look at the size of the angel and VC business, which is $75 billion a year in the US only, in an average year, not in a good year, but in an average year, and initial public offerings and secondaries for those same companies, raising $140 billion a year in an average year.
Is that global, or is that just
only
in
the US?
Only
just
the US
in
markets?
The US, yes.
Wow.
Because Reg A plus is US centric in the sense that companies have to have their headquarters here.
Yeah.
So using it as the basis, then when you say to yourself, well, all the startup companies, there are many, they are well supplied in general, and the companies that are strong enough and far enough along that they can do a regular IPO, raising an average of $300 million in that initial public offering.
Yeah.
That's $140 billion, makes sense. It's bigger sometimes, $250 billion a couple of years ago. For Reg A plus, for all of the mid-stage companies, and there are more than 1 million of them, even setting aside startups, just of the companies that are established and don't have a good place to go to raise sizable amounts of growth capital, 40 or 50 billion is right in the zone.
Okay, so let's take a step backwards, and for the entrepreneurs and investors out there that aren't as experienced with Reg A plus, can you just give kind of the layman's overview of what it is?
Sure. So it replaces Regulation A, which has been around for a long time and kind of went out of fashion in the 80s because of limitations in it. Regulation A plus, the little plus sign really doesn't let you know how big a shift there is. It's huge. So these are the fundamental differences. Private investors worldwide at any wealth level are allowed to invest. So for all those people that have been really interested in these kinds of interesting public companies, attractive public companies, that's new for them. Companies.
So this gets away from kind of the accredited investor requirements that are required prior to this for individuals investing in private companies.
Yes, and a very practical part of the rule system is that the company does not have to prove that. Where we can accept accredited investors as well, of course, and institutional investors.
Sure.
But you don't have to prove the wealth level. We trust the investor.
Yeah.
That's a nice situation. It makes it much more time efficient for the investor to make make their investment and complete the process at retail on the internet. Anyway, going back to the main thing. So anyone can invest anywhere in the world.
Okay.
companies can raise up to $50 million per year, and they can do another offering every year, a secondary, if you will.
Okay.
And there, if they do it, what's called a tier 2 offering, the companies are essentially, they're not required to satisfy the state's blue sky filings, which means it's practical to raise money.
Yeah.
By just registering with the SEC. You can use a broker-dealer or not.
Okay.
You can use a platform like my company, Manhattan Street Capital, or not. It's up to the company doing the transaction.
Yeah.
And then when you get down to some very important aspects, the shares that are purchased through Reg A Plus are considered liquid by the SEC immediately upon purchase. Now, the company can restrict them, but if they don't do so, the shares are liquid immediately. Then it's a matter of what does the company provide in the form of liquidity?
Yeah.
Is it listed or not? Doesn't have to be.
Mm-hmm.
Is it listed on an OTC market, or is it on the NASDAQ, or even on the New York Stock Exchange? You have a wide berth of flexibility as to where you put the company when you've completed the transaction.
So that's kind of interesting. So one of the big benefits of taking a company public, we took Entropic public in late 2007, so we went through the IPO process, all the different things that you have to do in terms of S1 filing with the SEC, very arduous requirements. In addition to all the requirements that are in place once you're a public company, Reg A Plus reduces a lot of that, but you're still able to trade on the same exchanges?
Well, no. Yes and no. So let me clarify.
Okay.
If you choose to use Reg A Plus and then list on the NASDAQ or the New York Stock Exchange, then there is a process to convert the Form 1A filing to the same level as S1.
Okay. All right.
And it ends up costing you as much time and effort as it would have done. It's spread out. But the advantage of doing the IPO that way is that, unlike a conventional IPO where you have to meet a minimum funding level to get listed on the NASDAQ, for example, if you don't meet that funding level in a traditional IPO, then it's, sorry guys, what a waste of time this was, egg on the face, pack your bags and go home, didn't raise $1. With the Reg A Plus method, then you can raise, let's say your minimum was 15 million for the NASDAQ, and you only raise 13 million. You complete the transaction, raise the money, and you don't list on the NASDAQ. You put the company on the OTCQX and stay there until you are ready to uplist at a later date.
So if you don't get to kind of upgrade to the minimum kind of S1 thresholds and all the other things that you have to do after you're a public company, is there an aftermarket for the so-called liquid stock? But is there an aftermarket for kind of Reg A Plus shares? I'll call them if you don't do those things.
So this is what's happening in that regard. If you list the company, by the way, you can list the company on the OTCQB, and it costs $2,500 for a ticker symbol, a fresh new ticker symbol, which is pretty amazing. If you go to the OTCQX, it's $20,000. But the point is that then you're listed, and of course you need market makers to provide proper liquidity, which is a function of engaging with them as well as having enough depth to your company that they're interested. So they want to provide liquidity, and the fact that we're generally seeing a lot of consumer investors, so a lot of shareholders in Reg A transactions, lends itself to being interesting to them. Because if you raise $50 million from 5 people, there is no inherent liquidity in that.
But now, are you just seeing kind of individuals, kind of what we would call retail investors, come in a Reg A Plus offering, or are you also seeing institutions come in and take shares?
At the moment, almost exclusively consumer investors. But let me get back to the liquidity issue, because there's some important things. For a company that does not list, that chooses not to list because they don't want to worry about having to justify fluctuations in their share price, they cannot list, but then they can either provide liquidity to their investors through a mechanism which they define up front as part of the offering. So now the investors know where they stand, maybe quarterly liquidity. And the other thing which is coming together is there are a number of startup companies that are being built to provide digital trading platforms for Reg A Plus shares that are not listed. And when they exist, there'll be a good way to go. There are some broker-dealers now, but it's too difficult to find them in the main.
So it's still very early. We're kind of at the very early innings. Can you distinguish Reg A Plus from Title III, Reg CF?
Yes.
So, and all this stuff is related primarily to the Jobs Act, correct?
Yes,
and
that's
this came
correct.
into existence based on that.
Yeah. So Reg CF, or Title III as it's also called, which has been effective since May of 2016, allows companies to raise up to $1 million from any level of wealth, from any investor.
So much smaller scale kind of equity crowdfunding.
It's very similar in concept. It's similar to Reg A+, but for seed rounds.
Yeah.
You can raise 100 or 200K. The more you raise, the more the due diligence process becomes involved. But I don't think it's an unreasonably involved process. No liquidity post-transaction.
Okay.
It's like, it's a bit like Reg D used to be for accredited investors. You're liquid, you're stuck. When the company does great, then you have a chance to make a lot of money.
Yeah.
You don't know when. That's fair enough.
Traditional private investing, but it lowers the threshold that you don't have to be an accredited investor for early stage.
Yes, and it's doing well. It's doing quite well.
Okay.
As a space for companies. In this, you have to have the same kind of appeal in a Reg CF company as you do in a Reg A plus company. And the point here is that because these are both new forms of raising capital.
Yeah.
The cynics, being the institutions and accredited investors who have so many other choices for where to put their money, tend to be slow to adopt new funding methods.
Sure.
So they're looking and they're monitoring the situation. And when there are enough newsworthy, great success companies that gradually will get past the perception that this is a new and risky thing. And part of the fact also, the bigger issue, is that since 1934, we've known that you can't do this stuff.
Right.
You have a quiet period, and now we're allowed to actually market our company instead of having to be silent and don't do anything unusual. And now, you've had a hard minimum. You couldn't do an IPO without that.
Yeah.
Now suddenly you can.
Yeah.
Ordinary people can invest $300 in your company, which has some attendant issues of how many investors you have, but that can be a benefit for listing and getting liquidity. So many little differences. The main issue there is that the bigger companies that I think are ideally suited to Reg A+, think 20 to 60 million in revenues.
Yeah.
They're the ones that have the more seasoned conservative board members and executive teams. And they're either happy where they are and unaware, because they're not looking, or they're aware of Reg A+, and they're waiting for it to prove itself.
Okay. Yes, I mean, from a product life cycle standpoint, we're in the early adopter stage of this kind of new funding mechanism, and to kind of cross the chasm, from a Jeffrey Moore standpoint, there has to be more stuff that comes in to kind of get into that early majority stage.
It takes time.
Yeah.
Reminds me of the early days in the PC industry when I was at Ashton Tate.
Right.
And I would meet people in all sorts of walks of life, especially mainframe hardware and software companies, and they would just blow off microcomputers and say, they're toys. Maybe my assistant could use it, but it would just be for entertainment, And of course, what we've seen is, the microcomputer took over the whole industry, and then the internet even more.
Yeah. So what are some of the recent metrics in the Reg A Plus market?
So Reg A Plus went live in May, the end of June in 2015.
Yeah.
And there's a lead time in getting transactions done. So the first offerings went live at the end of October of 2015.
Okay.
And since then, I did an update in Forbes recently, essentially assembling all the metrics on the status so far. And we've had 32 companies complete successful offerings since then, which really means to me from November 1st of 2015 through the period I looked at, which was the end of February.
Okay.
32 companies completed successful transactions in that time. And that's actually pretty good. That's about 25% of the companies that went to bat, that got qualified by the SEC.
Okay.
Meaning they persisted through the process, which many companies did. So
still smaller in terms of number of companies in the IPO market than the traditional private, equity market.
Yes,
but still
it's early days.
Yeah, but still pretty good. I mean, 32 over a few months is not anything to sneeze about.
So it's about 2 companies a month, raising, on average about $32 million per month, roughly speaking, and that's pretty good for private equity. Yeah.
I mean, that's one of the things when Anthropic made the decision to go public, and part of it was giving investors liquidity, obviously, but the public markets just have so much more capital, orders of magnitude more capital than the private equity markets.
Mm-hmm.
So it's hard to raise that kind of money in private equity. So this is, 32 million is a big number.
Yeah, because as you say, private equity companies look at this size range of businesses and say you're too small.
Yeah.
Banks say we'll lend you money, but only $1 million on your receivables with ridiculously high rate of
exactly.
interest.
Yeah.
Venture capitalists say you're too late. You may even be our portfolio company, and it's too late. We have
you have a very limited kind of narrow group of investors. There are these crossover funds that might do something,
right? But
that's a pretty narrow sliver of investors. Right. There's not that much capital in those guys, and it's kind of a supply and demand thing. They're only going to invest in a few companies.
Absolutely.
Anyway,
it's a very narrow. I was surprised to find that the whole private placement area.
Yeah.
Maybe I have the term slightly wrong. $1 billion a year of capital raised. Not private equity, but private placements where you have a broker that goes out and solicits the deal. It's hard to get those guys on board. Yeah. And that's only $1 billion a year. So it's really scratching the surface.
Yeah.
And then reverse mergers are a place that these companies can go to.
Yeah.
But they're raising on average $10 billion a year there right now. Except the expense is significant and the risk. So you may, you
got to find a very clean public shell, and if you find something that you don't, if it's not clean and you carry forward a bunch of liability,
you may never earn your way out.
Yeah, there can be big challenges for sure.
There's one other snippet on liquidity which people are not generally aware of. Up to 30% of an offering in Reg A plus can go to insiders.
Yeah,
and a significant number of transactions, the 21% is the average to date for tier 2 transactions.
Okay.
But the part that no one really knows is that because the shares of the company are now public, even though they're still in preferred and common and unchanged by the fact that you did the new issuance of Reg A plus shares.
Oh, so there isn't like a forced conversion like there is in an IPO?
No.
Interesting. Okay.
So you can go on raising money from preferred if you choose to into your preferred on whatever terms. But also, those shareholders, once they pass their Rule 144 holding period, then they can be liquid too, as long as their trading volume doesn't exceed the maximums, which are already there in place by the SEC.
Yeah.
And as long as they do it after the company has made an announcement of its result. So, which is an issue that I didn't explain too much, but once a year audits and once every 6 months, profit and loss and revenue reporting is required for tier 2 companies, which are the primary domain, the primary focus.
Okay, cool. So we're here with Rod Turner, for those that you didn't join at the beginning. He is the founder and CEO of Manhattan Street Capital, the #1 growth capital marketplace, doing Reg A plus offerings in the US and Canada. Just a wealth of information here. So if you have questions, you can submit questions at any time, and we'll go from there. So something triggered when you were talking about that. When I was running a public company, there's all the requirements around Reg FD, fair disclosure.
Mm-hmm.
Do those same kind of Reg FD requirements apply when you do a Reg A plus offering, or there's more latitude there?
Much more latitude. I've been told by people that are experts in S1 public company reporting who've compared that it's 1/10 as onerous. 1/10.
Okay.
So you need an audit, and you don't need to have a whole bunch of dedicated employees.
Yeah.
So the actual expense is really primarily the audit and some bandwidth from your inside team.
Yeah.
And that's it. Now, then, if you go to the QX, the OTC QX, then quarterly reporting is required for that market, but still once a year audits.
Okay.
It's pretty reasonable.
Yeah, it's not too bad.
Yeah.
So what types of companies are most likely to succeed with like a Reg A plus financing?
Yeah, so we mentioned earlier that the accredited investors in the main are not participating very much yet, and institutions the same. So we need to focus on companies that can raise money from consumer investors, from consumers, people that are not accredited, because the ones that are accredited currently are, risk averse.
Sure.
They're people, regular people, that maybe have to love the company enough that they want it to prosper, or they need it to prosper, and they're hoping it'll open a branch around the corner. I have a company that we've been working with in the background for a while, more than a year probably, and they have an incredible pain treatment system. So everyone has a relative a relative or a friend that is in agony and taking painkillers, which are gradually killing them, frankly.
Yeah.
And this is a tested system, FDA approved and patented. That when they get the other things that they're working on prepared, I think that'll be very appealing to consumers.
So things that have kind of that consumer-based understanding and appeal, just like the things that have done best in terms of pre-sales, crowdfunding,
Yes.
like on Kickstarter and Indiegogo, those are things that if it's super technical or something that consumers can't relate to,
then
it's tough unless you bring your own network to play on it.
Yes, that's right. So there are those. I mean, there are some companies that are already funded that have enough happy customers that they've already got the money lined up, but that's the exception. Another example is a stem cell company, which we've been working with for some time. It's such an appealing treatment. I believe that will be remarkably engaging, even though that is a business-to-business company, which makes it a little more difficult. But on the other hand, everyone wants their doctor to have this stem cell treatment, to fix the vertebrae in your disc or your shoulder or whatever. So that's another example. And obviously, as you said, the gadget companies, they're relatively easier to raise money from. And the best example so far was VidAngel, where in October last year they raised, their full raise was $10 million in the space of 2 weeks live on the market, 2 weeks of actually raising money.
Okay.
What they did a little bit of social media, but they emailed their most active customers.
Okay.
Their 30,000 active customers.
Wow.
That's...
Yeah, so the question...
So Paula says, I've seen REITs gain traction. Do you agree?
Yes. So this is E-REITs. That's the new term that's being used. Real estate is the most successful component or group.
So a REIT, real estate investment trust, for those of you that don't know the REIT term.
Yes. So the appeal of being paid a dividend, as well as you can see, the building is tied in so that there's a degree of security, and the concept isn't rocket science to understand.
Right.
We're seeing a lot of success in that area. Yeah. And the E-REIT term is being used because some of the more successful ones have been structured like REITs. One of the ones I like the most is Fundrise. I'm talking not about their investments. I haven't any idea how great their investments are.
Yeah.
But they are structured where they do not they lock the shares, but they provide stated terms of liquidity and quarterly liquidity with reasonable notice.
And they've gone through a Reg A Plus offering?
Yes, they have three. One of the great advantages of real estate is that so far it's the only place where, because you can geographically divide the US or other parts of the world, you can do three offerings simultaneously, or 4 or 5 or 6.
Oh, wow.
Normally it's just one, right?
Yeah.
Per company, per year. But what they've done is done 3 simultaneous, up to 50 million transactions, and they're marketing themselves incredibly well. And that's
interesting.
Yeah, that package with liquidity is very good.
I have another question.
Yes.
Does your platform allow for non-Reg A offerings such as 506C, understanding that we can only then look at accredited investors for a 506 and perhaps even Title III CF deals?
Yes, so we're not doing Title III Reg CF deals for 2 reasons. One is that you're required to accept all comers. When you do that, you establish yourself as a platform, and you cannot be selective about the companies that you take on.
Okay.
That to me is really bad news. I want to be selective and have a carefully picked group of companies.
Sure.
And there's a lot of regulatory requirements to go through, which is fair enough, but I don't want to divide and defocus the business. We are doing Title II or Reg D transactions, 506C, for select companies where they're subsequently doing a Reg A+.
So kind of like a pipeline,
Yes, a sequential process.
Yeah.
Yeah.
Okay, interesting.
And then we have 2 other questions.
Yep.
At what stage should a company consider growth capital using Reg A?
So what's happened so far is more early stage companies than I think are ideal are using Reg A+, in which case they have to have the emotional appeal to consumers and enough credibility and enough progress that they're real. and that they make it through the SEC process. And if there's a broker-dealer involved, that they're credible enough to pass their test as well as our test. So you can do it for very few, I call them mature startups. Startups that took 4 years to get here. They could go to VC if they wanted, not someone that just has a concept. The sweet spot, though, is for the companies that are established and are too mature and too far along for VC, but still too small for private equity or a regular IPO.
So of the 32 companies that have gone out using Reg A plus, and you may, these, like metrics I think about, do they have revenue? Do they have EBITDA? Are they, are they of a particular size?
Right.
Is there a particular minimum amount of money that they're trying to raise?
Yes. So the minimum raise amount there are some exceptions, but generally 3 or 4 million. The economics don't make sense below that.
Okay.
And the percentage of those companies that are, actually I lost my train of thought. There were 3 things I was going to say.
Yeah, so revenue, EBITDA, and...
Yes, so 30% of them have revenue, but about 16% of them have profits of the tier 2 companies.
Okay.
Yeah, the tier 1 companies so far have been almost exclusively banks because they're local. It makes sense to do it in 1 or 2 states.
Okay, interesting.
Where you have a big headache if you want to go across to further.
Yeah, question?
And then we have a question from Cal. How will the new presidential administration affect the Reg A and crowdfunding industry?
Yeah, what a great question. Huh? I was going to write a column on that, and I just couldn't find a way to write it and have it be, just positive. So anyway, the point is that it seems to me that we'll see less regulation, and it'll be easier to do Reg A plus transactions. That's the bottom line. The specifics of that we are yet to see. The guy that is going to be the new chair of the SEC seems like a very seasoned professional with a very pragmatic view and a lot of relevant experience. And so I'm hoping that FINRA and the SEC will knock down some of the hurdles that we face. This is a complicated business. That's why we don't have 30 competitors, because it's difficult to figure this all out and navigate the lines properly.
Sure. So how long does it take to complete a Reg A plus offering? I mean, I know when Entropic went public, we had the initial thought process, like in December, January, we needed to complete an acquisition. And then we went really fast track, and it still took us like 5 months to get public. So is Reg A plus similar, or is it different?
It's similar. No, it is similar. Once you have the audit done, which of course, if it's an early stage company or a newly formed entity, which some companies are doing, then the audit can be quicker. But once the audit is complete, then it's 60 days. If you do a good job of execution, which is critically important to project manage this stuff well, 60 days later, you can be raising money. And then the question is, how long does that take? And that's going to be at least a month, except for companies that already have their investors lined up, which I've got a couple of companies like that. That's delightful. It could be done in a week. But, the norm is going to be 2, 3, 4 months.
So it's similar. I mean, I did a Kickstarter for my new book. So, and I never even thought about doing that, but I talked to John Lee Dumas, the famous podcaster, and he did one for his book. So I said, it's good enough for John Lee, it's good enough for me. But I always thought of Kickstarter as a platform primarily for gadgets and stuff like that. But I did it, but my experience with it was that farming my own network as opposed to allowing the platform to kind of drive the demand was essential. So do you see the same kind of phenomenon in a Reg A plus offering where you've got to do the groundwork and get investors excited on your own? And talk to me a little bit about that.
So the most critical component of success for these offerings is once you've got a company, once the company is identified as being a viable transaction because they have enough consumer appeal and all the other things, then having a marvelous marketing agency that knows what to do, loves the company, and proposes a reasonable budget to do it. So that's usually 2 to 4% of the capital that's raised. It's not charged as a percentage, obviously, but I'm just framing it. And when it's done right, it's very similar technique, frankly, to what you see on Kickstarter when it's done right. And it's amazing how much work has to be done, the project management that needs to be done, all the different marketing bases that have to be covered. We've got so much better tools these days than ever before. But
So are there PR and IR, public relations,
Yes.
investor relations agencies that are now specializing in this?
Yes, well, not IR so much. That's usually considered for later, right?
Okay.
But yes, there are agencies specializing in this. We've picked 4 that we work with.
Okay.
And, you know, we have a rapport with them. We don't control them,
Sure.
but they want to see the continuing flow of companies from us. And
Okay.
they're good people, you know. So I'm involved, we're involved in maximizing the likelihood of success, making sure there's no missed bits and that the pricing is reasonable and
Sure.
the execution works really well. But that is absolutely critical. The great thing is with digital marketing, you don't have to spend long to figure it out, right?
Yeah.
If you're testing it, you can test it on a low budget and do that quickly. And if you're ramping up and it's working, you know, and if it's not working, you know. I mean, this isn't mystery. You don't like print media.
So talk to me a little bit about that, testing the waters, and kind of what does that mean in terms of Reg A+.
So testing the waters is a very neat aspect of Reg A+ that hasn't really been used properly yet, in my view. So the idea of it is that I actually suggested this to the SEC in 2012, frankly. The idea of it is you don't have to pay for the audit. You don't have to get a legal firm to do your filing and start the big buck spend just to test your company out and see if it engages with enough interest.
Yeah.
So that's the idea. What's happened to date is the companies that have used it, they're already committed, they're already doing everything, and they put the offering up in test the waters for a while to generate a lot of enthusiasm so that when they turn on funding, it'll be more successful.
So kind of pre-demand generation type of stuff.
If it's got, in my view, you should only do it for a couple of weeks, because if you do it longer, then it actually makes it harder to re-engage those people because they went stale. You know, they've been waiting for 2 or 3 months.
Yeah, then they get tired of it.
Yeah, they do something else with their money or
sure.
focus their enthusiasm on something else.
Yeah.
So that's what's been done. What needs to be done and what we're offering is, I'm calling it Test the Waters Audition. Companies can inexpensively just check it out, put together an offering. We'll help them where we can help them test messages to see what the appeal is and then run a low budget advertising campaign to see how much enthusiasm we get.
So is it kind of like A/B testing where you'll test a couple? Okay. So
a few different messages that are right on.
Okay.
And you get surprised sometimes, as you know.
Of course.
Because you think it's going to work. It bombs miserably. But that other one over there that looked hinky, suddenly it's incredible.
Yeah.
Yeah. So
interesting.
That's the way to do it, in my view. And then you don't have a lot of money in play. You didn't take any big risks.
Sure.
And we set the stage, you know. So
do you raise any money in that, or you're just kind of testing messages?
No, you are not allowed to raise money in any of the Test the Waters incarnations. That's the part that the SEC is most concerned with, is that it's done cleanly, without hype, and that you don't do anything remotely like raising money.
So in the IPO process, you know, even though it took, I guess, 5 months, most of that time was in the back and forth with the SEC around getting the S1 approved.
Getting it approved. Yeah.
Then we did the IPO roadshow, and the IPO roadshow lasted 2.5 weeks, and that included, you know, a trip to Europe.
Yep.
So the actual time spent in raising money was 2.5 weeks, even though there was, you know, a lot of PR, you know, and everything else. You know, a lot of people know, hey, this is coming, etc. In the Kickstarter, you know, all the stuff that I read was don't do a Kickstarter longer than 30 days. You know, so are similar kind of rules of thumb that you use in Reg A+ around, you know, the amount of time that you're actually out there raising money?
Well, not yet.
Okay.
Right. I mean, I have my perception on all these different parts by observing offerings and seeing how they're working and how quickly they work. But I do believe, frankly, that because by its very nature, this is a public funding method, right?
Yeah.
You need to succeed and you need to be seen to succeed rapidly.
Yeah.
That's where the 30 days thing kicks in.
Early momentum's key.
Yes, because now everyone jumps on board. But when you're raising money, there are other methods that you can use that are legitimate and that create excitement. So that's something that we are innovating in. I think we'll do well with that. So that's a latitude you don't have with a Kickstarter situation.
Yeah.
But basically the same thing applies. You've got to show momentum quickly. And the faster it is, the easier it is to do the rest of the raise. Yeah. And then it's all the obvious things about marketing.
Yeah. Yeah. Why that's been the case anytime I've raised capital in private situations or public situations. You got to find that anchor tenant to kind of come in and lead and show that early momentum, then everybody else kind of comes in.
Yep.
It was interesting. I was looking at Kickstarter when I was running my campaign.
Creating a perception of rarity value.
Yeah. So I would say on the kind of, they've got a page like these are funding campaigns that are ending most within the next week.
Mm-hmm.
So, and I just looked at the nonfiction publications because that's the category I was in. Mm-hmm. But it was fascinating to me, like only maybe 20%, 20% of them were getting funded.
Yeah.
And it's you have to reach your funding threshold or you don't get it.
Yeah,
so
right,
it's digital.
Managing expectations,
yeah.
right? Starting out. That's another issue with Reg A+. So many companies say, well, I can go to 50, so let's have a 50 maximum. But then when you start raising the money, it's 4 weeks in, you raised $4 million. Everyone's celebrating.
Yeah.
It's $4 million we didn't have.
Yeah.
Now we've got it, but 4 million compared to 50, it's boring. It's not enough.
Yeah.
So you've got a perception issue there, which is actually totally manageable, but you have to manage it.
Yeah. So do you have to set a funding threshold where if you don't raise that much, you don't? So Reg A Plus is more open-ended.
You can have a zero minimum as long as you're not buying something. You're buying a building for $6 million, you need a minimum of $6 million.
Okay.
Right. But beyond that.
Okay, interesting. Yeah,
Paula
question?
asks, can you address what can be done to make the broker-dealer community comfortable with Reg A?
Wow, great. I was thinking to talk about that. That's perfect timing for it. So there are a number of active broker-dealers now in the Reg A Plus space. And I get regular calls, not frequent, but regular calls from relatively bigger underwriters who are interested to see this and how would we work together, the beginnings of the change, right?
Bulge bracket guys are more kind of second tier and third
second tier.
Okay.
Yeah. But that, they're calling me to find out about how we could work together. That's a pretty positive thing.
Yeah.
So, but having said that, the biggest single issue that there's a misunderstanding about broker-dealers and what they do. They add a lot of value, but only once you've already shown that you have a success at the retail investor level.
Yeah.
If you're dragging and it's not working there, then the broker-dealers are not going to risk their relationships with their clients and go to bat for you because the likelihood is it's going to fail.
Yeah.
The dialogue will fail.
Do you need the broker dealers to make a market in the stock, or you can
post offering? You do.
Okay.
Yes. Yes, you do post offering, but in the offering, it's optional to have a broker dealer involved, and they can add a lot of value. So, for example, we instrument when people go through the investment process, but stop partway through.
Sure.
Then we flag that information and send it to the broker dealer, and they're allowed to, and it's what they do, to call those investors up and help them understand the nuances of the business, and they can take an investment that way if they choose, if it makes sense for the investor.
Sure.
So doing that in the right method is important, but the point is that that's a natural thing for a broker dealer to do, and they can do that day one when you're live. But what people really want is they want their investor clientele.
Sure.
They want which generally are accredited investors and institutions. And then you're back to the same point again, which is realistically, once we've already made it successful, where it's, they raised $4 million on a 6 goal, or they raised $12 million on 20 goal, and they did it in 4 weeks flat.
Yeah.
Okay, this is looking good. And they raised the share price.
Yeah. Now
we've got reasons to call your client because they just raised the share price.
It's a hotter deal.
Yeah. But until that happens, they will not add that value. They will not bring in their investor client.
Sure. So, I mean, similar to kind of being picky when you're looking at, they'll pick and choose what companies they want to take public too.
Yeah.
So you got to kind of meet. It's a two-way courting. A two-way courting process.
Right.
You're courting them, they're courting you.
Yeah, they don't want a roadshow when nobody shows.
No, exactly. Yeah. So, what are the various phases of an offering, a Reg A Plus offering?
Bear with me a second. I just wanted to make sure I answered that question.
Was that Paula? Did you get your question answered?
Let us know if we didn't answer your question, Paula, and we'll.
So your question was, what are the phases?
Yeah. So
flirting with the idea, checking it out, right?
Yeah.
Evaluating, should we do this? Past that, then it's audit, and then because that's the critical path item.
Yeah.
And then in parallel with the audit, get the Form 1A filing done, get the marketing agency on board.
Yeah.
And then in the 60 days after the audit's completed, you can be done with the SEC part in as quick as 55 days.
Okay.
But 60 days is repeatable. The average is 78.
Do you still get the kind of same level of comments back and forth between the SEC as you get in
not
the
as
S1?
much.
Okay.
No.
Okay.
The degrees of freedom are far fewer. It's a simpler transaction. transaction.
Okay.
And the SEC's been super with this. You know, we were worried that they wouldn't have enough resources.
Yeah.
They've been great.
Are the audit fees and legal fees typically lower in a Reg A Plus offering versus a public offering?
Yes. So the Form 1A filing fee, you can pay as much as you want, right? But it starts off at $50K.
Okay.
All in.
Okay.
Including the offering circular, which is the the red herring equivalent that's online.
Right.
And then audit is whatever it is. You don't get a special deal.
Sure.
Although the amount of work that the auditor has to do as a part of the SEC filing is reduced, so that part's reduced cost. And then the marketing stuff is the marketing cost, But the biggest issue, one of the biggest issue, tends to be how much is the upfront cost, and it's a minimum of $80K. If you're really careful who you use for a small raise, that's marketing and legal service provider, not counting the audit, because the audit is, depends on the complexity of the business and on which auditor you choose.
Yeah.
So about $80K up to $200K, maybe $300 for a large raise in terms of preparing the ground properly.
Okay.
And then you can usually raise funds, use proceeds to pay for the ongoing marketing if you choose to do that.
Okay.
Yeah. But you asked about schedules. So audit, Form 1A filing, which is 2 months, as well as marketing preparation going on. Go live. I would rather not go live in test the waters when you know you're marketing it. Go live to investors. It's a better test. It's real.
Yeah.
And then 1, 2, 3, 4 months of marketing to bring in investment.
Okay, so it's that long.
Yes, it is. But the good news, relatively good news, is you're bringing in investment money right away. You can do the first closing when you're ready.
Yeah, so you can do kind of mini closings and actually get the cash
every week,
in.
every 2 weeks.
Oh wow!
It's not an all or nothing thing.
Yeah.
So it's not this bad.
Well, not all or nothing. It's not. You have to get to the end zone before you basically bring the money in.
Right. It's a definite transaction as long as you're not buying something.
Okay. Yeah. Interesting. Yeah, that's a big difference.
It is huge. Yeah. From a cash flow point of view.
Yeah.
Another question from Rosaria. What if a company is headquartered in Canada? Can it still avail of Reg A?
Yes, it can. So it's companies in Canada have the same rights that US companies do to conduct a Reg A plus transaction. They are not able to sell shares to Canadian citizens because that is regulated by the Canadian government, right? But Reg A plus allows them to raise money from all other countries and from the US. Something else that's happening is that we're seeing more established non-US, non-Canadian companies coming here to move their headquarters here to raise money.
So they have to have a physical headquarters here?
Yes.
And then most of these companies are Delaware corporations as well.
Yeah, usually, yes.
Yeah, so similar to
or Nevada.
Yeah.
But more Delaware. But the point is that generally speaking, that's its own selection criterion. A company that can afford to move their headquarters over here to do this transaction, they're much further along.
Sure, of course.
So we're seeing more mature companies from outside the U.S.
Okay, interesting.
Yeah.
So we're here with Rod Turner, the CEO and founder of Manhattan Street Capital, the #1 growth capital marketplace for the best mid-sized U.S. and Canadian companies, talking about Reg A+. We're taking your questions. How are we doing on time, Amanda?
It's 11:21 right now.
Okay, so we have about another 10 minutes. Are there other questions from the audience? And I've got a few more here for Rod, as we kind of go through that. Are you required to take a company public after Reg A+?
Great question. And the answer is, it's a double-barreled answer. Technically, you do, because the shares are tradable as far as the SEC is concerned.
Sure.
If you lock them, for example, you might lock them for 5 years or lock them until the company lists.
Yeah.
Then they are not tradable.
Okay.
So you're not public, actually.
Right.
And you can then, you choose to provide liquidity or not, and that's a part of the offering. It's all open and above board along with the risk factors.
Sure.
So then you're not actually taking the company public. You're raising money through a convenient method.
Okay.
Or you can take it public as discussed. So it's your choice. But some people do think that they're forced to do an IPO to the NASDAQ, which is absolutely not true.
Okay.
Yeah. I think the sweet spot, frankly, for some time is going to be OTCQB and OTCQX.
Okay.
Because along with the reduced reporting requirements, so you can stay legitimate.
Yeah, the listing requirements are much less onerous.
Yes.
On those exchanges.
And as the number of companies there increases, and then we're actually going to build our own research analyst service, because these companies need low-cost analyst following.
So is there a big public market for these kind of micro cap stocks, or are they, more small cap stocks that are just on a lower exchange?
They are micro cap stocks, aren't they?
Yeah.
So far, some of the companies that I'm seeing are far further along. They're big small caps.
Okay.
Yeah, but that's there aren't going to be a lot of those right away. It's going to be a few over the next 12 months.
Okay, so it really is kind of that micro cap. I want some liquidity. I want to raise a decent amount of money.
Yeah.
I want to have fewer restrictions, lower cost,
more control.
Yeah.
Because venture capital is a superb way to go, as you know, and I know you've worked with Mission Ventures and others, great firms, and I've worked with Klein & Perkins and other great firms too.
Sure.
But they're the creme de la creme, the exception that proves the rule and all that.
Sure.
And sometimes it's that the founder doesn't want to risk being booted because the VC firms decide they have a different agenda and schedule for the growth of that company.
Yeah, for sure. There can be a lot of different agendas going on there.
Yeah.
Interesting. So, any other questions from the audience, Amanda? Okay, I've got a couple more.
Cool.
Is a Reg A Plus available for companies whose operations are outside the U.S. or Canada?
Yes, I mentioned that. So that's happening on
but they have to move their headquarters here.
The legal headquarters have to be here.
Okay. And what are the greatest risks associated with a Reg A Plus offering?
That it doesn't succeed.
Okay.
So then, as in a Kickstarter environment, some people are afraid to list their company in a public forum because they're worried they'll give away their strategy, which you almost certainly do.
Yeah.
So they're worried that by tipping their hand to their potential competitors, they'll create a landslide of competition. And then if it doesn't succeed, that's the worst case scenario, right? You went out with an idea that you can't actually harvest without the capital and it doesn't work. That's the worst case scenario.
Yeah.
Every company isn't going to choose to take this route because some companies are such that they're concerned about that. And then there are others, the biggest thing that I do up front with companies is help them understand if they really are a fit for Reg A Plus, or really if Reg A Plus is a fit for them at this stage in the game. So they don't waste their time and money if it won't work.
But a lot of that's how you communicate. Companies that communicate effectively don't necessarily give away all their secrets.
But that's true.
Secret sauce.
Well, you can have this black box over here.
Exactly.
And you can talk about what it does, but no one knows how it does.
Exactly.
Right.
Yeah.
Yeah, that's it. That's true, isn't it?
Yeah.
You get to that. There are a whole bunch of those like that where it's actually fine. You have no risk.
Yeah. So we're getting near the end here. Were there any kind of parting comments, anything you want to talk about with respect to Manhattan Street Capital, or any kind of key points that we left out?
Yeah, so I would say the main issues are, I see a lot of companies making mistakes. They'll come to me and they're partway through a journey where they've been given some duff advice or they've advised themselves, and they're kind of spent up quite a bit of money to get nowhere really because they're partway through the SEC filing, and it's like, okay, really what you have to do is restart this puppy because it's going to cost significant amount of time and effort because the way you've gone is the wrong journey.
Yeah.
And the fact that you got these things approved doesn't help you because you're not going to succeed with that transaction. So my point really is to seek experienced advice. Obviously, I'm biased. I think they should all come to Manhattan Street Capital.
Sure.
But it's okay to go to one of our competitors. I won't be I will be offended, but just don't tell me. But the point is to get professional advice and it's not a big law firm, a big auditing firm that are experienced with IPOs and all that stuff, because actually this is different enough. You want people that are in this space, in Regulation A, auditors and particularly the marketing agencies and the law firms that are practiced in this space. Those are the people you want because they'll spend less money and get a faster result.
Sure.
Whereas you're educating the giant firms and you pay through the nose for that. Yeah. And it costs so much time.
I mean that's always great advice in raising capital generally. Get the best partners. Get the best bank, get the best attorney, get the best auditor, get the best marketing firm.
Right.
Pay a little bit more to get the best if you can afford it,
right,
or get the best that you can afford, because
yeah,
there are so many people out there that
right,
really say they know what they're talking about,
right.
that really don't.
And they have probably great intention,
Yeah,
you know, but they come from a different set of variables, a different place. I've seen some horrific stories, you know, where one company was in test the waters for 6 months waiting on
my
their
gosh.
updated audit.
Yeah,
You know, you can bet they weren't told it would be 6 months. I know they weren't told it would be 6 months.
yeah,
And they were in test the waters the whole time,
yeah.
you know. So
it looks really stale at that point.
yes, it is, and it was.
Yeah.
You know, because the early adopters, they're the ones that jump on it first.
Right.
And they're the ones who you lose first if you don't have, you know, a relatively close time frame.
Okay.
So that's one thing I would say. And the other thing is to make sure that you do a thorough job, because you got to like the people you're working with.
Yeah.
Because there's so much involved in this. Like with you when you did your IPO, this is simpler, but you got to like the other people.
Yeah, I mean, you're working with them, you know, shoulder to shoulder, hand in hand for months.
For a long time.
Yeah,
It's a lot of meetings, a lot of phone calls, a lot of trust.
Yeah.
You can't predict every variable up front. You have to know the other other person is going to be reasonable to deal with when that surprise comes along, or some other one.
Yeah.
It's a journey.
Yeah, for sure.
And it'll all get easier with time and practice and repetition.
Yeah, as you see more track record being established, you know, it's easier. But I think this does provide a very unique and new and valuable way to raise capital that previously didn't exist.
Yes.
I mean, this is much, much different than what existed before.
Yes, indeed. Yeah. I get, you know, from time to time, I'll have conversations with people from the investment bank industry. Many of them are very skeptical about anything new, and Reg A plus to them is, haven't heard about it enough, therefore it doesn't matter, kind of thing. But then there are others who look at it more closely, and they're changing their entire business model and focusing on this and partnering with us, you know, bringing really solid companies, which is fantastic, you know, when you meet the people that get it. And this does remind me so much, again, of the microcomputer revolution as it took over from being, you know, a toy. The perception was that it was a toy, and then look what that toy did.
Yeah, I mean, there's two things I kind of apply from a product standpoint, product company standpoint, that I think apply. One is that crossing the chasm, you know, Jeffrey Moore concept, where we're in that early adopter phase, but as that gets momentum and people get comfortable, broker-dealers get comfortable, you know, the ecosystem gets comfortable, this thing can just skyrocket. The other thing is the innovator's dilemma. I mean, this is a much lower cost way of doing something that previously didn't exist.
Right.
And in the beginning, everybody was skeptical, and it's like, you know, this is a toy. This is for novices. This isn't for us professionals.
Right.
But as it gets refined, there's big opportunities.
Absolutely right. Yeah. And I see this already. That the fees we charge have been going down. We've reduced our fees, and I believe that's a part of the game. You know, if we aren't able to reduce the cost of these transactions with time, then why the hell are we doing this?
Right. Yeah, it should be more efficient. It should be, you know, faster. You know, lower cost. You know, so
more and more automated. You know, more and more state of the art technology. We have an algorithm. Which is a living, breathing thing, as they have to be if they're going to continue to stay state of the art, which monitors a bunch of interesting activities on our platform. And that's an example right there. It's AI. It is AI.
Yeah, it's AI.
Right,
I mean, it's big data. It's AI. It's going to allow you to be more efficient in making offerings over time, you know, as you use that data in a very intelligent way.
Right. We use it primarily to identify risky investors, because lawsuits are a scary phenomenon in this business.
Of course. So what's the best way to get a hold of, first, were there any other questions, Amanda, before we, okay. So what's the best way to get a hold of you?
Just send me an email, rodturner@manhattanstreetcapital.com. That's the best way. Through the website, too, there's a bunch of different touch points that you're welcome to reach out to us. And where it says us, it's usually ends up in my lap when it's a new company discussion.
Okay, awesome. So Rod can also be found on Twitter at @IamRodTurner, and he is a contributing writer for Forbes, so definitely check out his existing articles there. I've read a few of them, and they're very, very good and thoughtful and really insightful on Reg A Plus and kind of what's going on there. Thank you so much for joining today.
Thank you.
And great to see you again.
Yeah, same here.
Thanks,
Cheers. Thanks. Cheers, guys. Thank you very much.